Most traders spend their whole life searching for the perfect indicator. They look through for moving averages, RSI, MACD, secret formulas, paid signals, expensive courses, and magical entries. But let me tell you something I learned after losing fortunes and making fortunes in the market. The real indicators are not hidden inside your trading platform. They are hidden inside the market's behavior, inside the crowd's fear, inside your own patience, and inside the silence before the biggest move begins. 90% of traders will never find these indicators because they are looking at the screen, but they are not reading the market. They see candles, but they do not see intention. They see price, but they do not see pressure. They see movement, but they do not understand the mind behind that movement. When I was young, I thought trading was about being smart. Later, the market taught me it was about being patient. Then, after many painful years, I learned the final truth. Trading is not a game of prediction. Trading is a game of recognition. You do not need to know the future. You need to recognize when the market is telling the truth. And today, I will tell you the 3 indicators that most traders will never find, not because they are secret, but because they are too simple for the greedy mind to respect. Indicator number 1, the line of least resistance. Indicator number 2, the pivotal point. Indicator number 3, the operator's mirror. Listen carefully, because once you understand these 3, you will never look at the market the same way again. Before we talk about indicators, you must understand one thing. The market does not care about your dreams. It does not care about your rent, your bills, your confidence, your ego, your prayers, your hopes, or your revenge. The market is not cruel. The market is honest, and that honesty destroys people who live in illusion. A trader enters a position and says, "This stock must go up." Why must it go up? Because he bought it? Because he needs money? Because someone on YouTube said it will go up? Because last week it moved 20%? No, the market does not move because you need it to move. The market moves because supply and demand are fighting, and one side becomes stronger than the other. That is all. In the market, your opinion means nothing until price agrees with you. This is where most traders fail. They trade their opinion. A professional trades confirmation. A weak trader says, "I think it will go up." A strong trader says, "The market is showing me buyers are in control." There is a difference, and that difference is the gap between gambling and speculation. Gambling is when you want the market to obey you. Speculation is when you wait until the market reveals its own intention. That is the first lesson. Never argue with the market. The market is the judge. Price is the verdict. Volume is the witness. Time is the punishment for impatience. The first hidden indicator is called the line of least resistance. Most traders will not find it because they are searching for signals. But the market does not speak in signals. The market speaks in direction. The line of least resistance means this. The market will move in the direction where it faces the least opposition. If buyers are stronger than sellers, price goes up. If sellers are stronger than buyers, price goes down. If both are equal, price goes nowhere. That is the whole market. Every candle is a fight. A green candle means buyers won that moment. A red candle means sellers won that moment. But one candle is not enough. You must watch the whole battlefield. Let me give you an example. Imagine a stock has been stuck between 100 and 110 for many weeks. Every time it reaches 110, sellers come in and push it down. Every time it falls to 100, buyers come in and push it up. Most traders become bored. They say nothing is happening. But a professional does not see boredom. A professional sees compression, pressure building, buyers and sellers preparing for war. Then one day price breaks above 110, but not quietly. It breaks with strong volume. It closes above the range. It does not immediately fall back. Now the market has spoken. The sellers at a 110 were defeated. The road above has less resistance. That is the line of least resistance. This does not mean the stock will go straight up. Nothing goes straight. But it means the path of power has shifted. The market has chosen a direction, and your job is not to argue. Your job is to follow. Most traders do the opposite. When the stock breaks out, they say it is too high now. Then it goes higher. Then they say it cannot go higher. Then it goes higher again. Finally, when it has already made a big move, they buy out of fear of missing out. That is when the professionals start selling to them. Understand this deeply. A stock is never too high to begin buying if the conditions are right, and it is never too low to begin selling if the conditions are weak. Price alone does not tell you expensive or cheap. Market strength tells you. A stock going from 100 to 120 with powerful demand may still be A stock falling from 100 to 70 may still be weak, not cheap. Cheap things can become cheaper. Strong things can become stronger. The amateur wants to buy low and sell high. The professional wants to buy strong and sell stronger. This is why the line of least resistance is powerful. It keeps you on the side of force, not on the side of hope. So how do you identify the line of least resistance? You ask 3 questions. Question 1. Is price making higher highs and higher lows? If yes, buyers are controlling the direction. Question 2. When price pulls back, does it fall weakly and recover strongly? If yes, sellers are not powerful. Question 3. When price breaks an important level, does volume increase? If yes, large money may be participating. This is not magic, this is observation. Trading is not about seeing more indicators. Trading is about seeing more clearly. The beginner fills his chart with tools until he cannot see the price. The professional removes everything until only truth remains. Price, volume, time, behavior. That is enough. Let us imagine 2 traders. Trader A is emotional. Trader B is patient. A stock is trading at 50. It rises to 55, then 58, then 60. Trader A says it has gone too high. He shorts. The stock goes to 63. He says now it must fall. It goes to 67. He adds more short. Now he is not trading the market. He is fighting it. Trader B watches the same stock. He says the line of least resistance is upward. Buyers are accepting higher prices. Pullbacks are shallow. Volume is supporting the move. He does not short because his ego wants a top. He waits. Maybe he buys on a proper pullback. Maybe he waits for a breakout. Maybe he does nothing, but he does not fight strength. This is where money is saved. Sometimes the best trade is not the trade you take. It is the mistake you avoid. A trader who avoids bad trades is already ahead of the crowd. Remember this, you do not need to catch every move. You need to avoid the moves that destroy your account. The second hidden indicator is the pivotal point. A pivotal point is not just support or resistance. It is a price level where the market must reveal its character, the point where hesitation ends and decision begins. Most traders draw lines everywhere. Support here, resistance there, trend line here, Fibonacci there. Their chart looks like a spider web. But the professional looks for one thing. Where will the market prove strength or weakness? That is the pivotal point. Let me explain simply. A stock has been rising from 40 to 60. Then it pulls back to 52. Then it rises again and approaches 60. At 60, something important happens. If price breaks above 60 with power, it proves buyers are still strong. If price fails at 60 and falls, it proves sellers are defending that level. So 60 becomes a pivotal point, not because it is a magic number, but because many traders are watching it. Old buyers are waiting to sell. New buyers are waiting to enter. Short sellers are waiting to attack. Institutions are watching liquidity. The crowd is emotionally attached to that level. That is why pivotal points matter. They concentrate emotion, and wherever emotion is concentrated, opportunity appears. Most traders enter randomly. They buy because they feel excited. They sell because they feel scared. A professional enters near a pivotal point because risk becomes clear. If the level holds, he is right. If the level fails, he is wrong. That clarity is priceless. The best trades are not the trades where you can make the most. The best trades are the trades where you know quickly if you are wrong. This is a secret most traders never understand. They focus on profit. Professionals focus on risk. Profit is not in your control. Risk is. You cannot decide how far the market will go, but you can decide where you will exit if the market proves you wrong. That is why pivotal points are powerful. They give you a clean battlefield. There are 3 types of pivotal points you must understand. The first is the breakout pivotal point. This happens when price breaks above a major resistance or below a major support. For example, a stock stays under 200 for months. Every rally dies at 200, then suddenly it breaks 200 with strong volume. That is not just a line breaking. That is a psychological prison opening. All the people who sold at 200 may now be wrong. Short sellers may have to cover. Breakout traders may enter. Institutions may add positions. The crowd may begin to believe. A new move can begin. The second type is the pullback pivotal point. This happens after a breakout. Price breaks above 200, goes to 220, then comes back to test 200. Now 200 becomes important to get. If price holds above 200, old resistance becomes new support. That tells you buyers are defending the level. But if price falls back under 200, the breakout may have failed. This is why you must watch how price behaves after the breakout. A real breakout often holds. A fake breakout traps. The third type is the climax pivotal point. This happens after a fast emotional move. A stock rises too quickly. Everyone is excited. News is everywhere. People who never trade begin talking about it. Volume explodes. Price makes a large candle. Then suddenly it cannot go higher. That may be a warning. When everyone is already in, who is left to buy? The market needs new demand to keep rising. When demand is exhausted, even good news cannot push price higher. This is where greed turns into danger. Many traders lose money because they want to be early. They want to buy before the breakout, to short before the top, to predict the move before the market confirms it. They think being early means being smart. But in trading, being early is often the same as being wrong. If you buy before confirmation, you may sit in a dead stock for weeks. If you short before weakness appears, you may get squeezed badly. If you enter before the pivotal point activates, you are guessing, and guessing is expensive. The market pays you for timing, not for imagination. I learned that the hard way. There were times I saw an idea clearly. I knew a stock should move, but I entered too early. And because I was early, I became emotional. The market moved against me. I doubted myself. I exited. Then later, the real move began without me. The idea was right, the timing was wrong. And in trading, a right idea with wrong timing can still lose money. That is why you wait for the pivotal point. You let the market open the door, then you walk through. Do not kick the door. Do not beg the door. Do not imagine the door is open. Wait until price proves it. The third hidden indicator is the most important. It is not on the chart. It is inside you. I call it the operator's mirror. Most traders never find it because they do not want to look at themselves. They want to blame the market. They blame whales, brokers, manipulation, news, algorithms, luck. But the most dangerous enemy in trading is usually sitting in your own chair. Your fear, your greed, your impatience, your ego, your need to be right, your revenge after a loss, your excitement after a win. These emotions are indicators. When you feel desperate to enter, that is an indicator. When you feel unable to take a loss, that is an indicator. When you feel like doubling your position to recover, that is an indicator. When you feel like you cannot miss this trade, that is an indicator. But most traders ignore these signals. They treat emotion like a weakness. No, emotion is information. Your job is not to become emotionless. Your job is to stop obeying emotion blindly. When the crowd becomes greedy, prices often become dangerous. When the crowd becomes fearful, opportunities may begin forming. But you cannot read the crowd if you are trapped inside the crowd. You must step outside. You must observe yourself as if you are observing the market. Ask yourself, why do I want this trade? Is it because the setup's strong or because I am bored? Is the market confirming or am I forcing? Am I following my plan or am I trying to recover yesterday's loss? This is the operator's mirror. It shows you whether you are trading like a professional or behaving like the crowd. Let me give you a simple example. You take a loss in the morning. Small loss, normal loss, part of business. But instead of accepting it, you become angry. You say, I will make it back today. Now your mind has changed. You are no longer trading the market. You are trading your wound. You enter the next trade too quickly, it loses. Now you increase size. Another loss. You are not a trader. You are a gambler trying to escape pain. The market sees this every day. It does not need to defeat you. You defeat yourself. This is why self-control is not motivational talk. Self-control is a trading edge. A calm trader can wait. A desperate trader cannot. A calm trader can cut losses. A proud trader cannot. A calm trader can sit with a winner. A fearful trader takes profit too early. The real money in trading is not made by being busy. It is made by being right and sitting tight. But sitting tight is impossible for a man who cannot sit with himself. Now you may ask, if these indicators are so powerful, why do 90% of traders never find them? Because they are not exciting. The line of least resistance requires observation. The pivotal point requires patience. The operator's mirror requires honesty. And most traders do not want these things. They want excitement, quick money, a shortcut. They want someone to tell them buy here, sell there. They want trading to feel like action. But the greatest trading often feels boring. You wait, you watch, you prepare, you do nothing. Then when the moment comes, you act with force. That is professional speculation. The amateur is always in the market. The professional is always ready for the market. The amateur wants entertainment. The professional wants opportunity. The amateur measures success by how many trades he takes. The professional measures success by how well he protects his capital. A trader without capital is like a soldier without ammunition. You may have courage, knowledge, and dreams. But if your account is gone, you are finished. So protect your capital. Do not waste it on weak setups. Do not donate it to boredom. Do not risk it because your ego is hungry. Wait for the market to come to your price. Wait for confirmation. Wait for the pivotal point. Wait for the line of least resistance. And when your own emotions become too loud, step away. The market will open tomorrow, but your capital may not. Now let us turn these three indicators into a simple framework. Before entering any trade, ask yourself 5 questions. Question 1. What is the line of least resistance? Is the market moving upward, downward, or sideways? Do not force a trend where there is no trend. If price is in a range, respect the range. If price is trending, respect the trend. Question 2. Where is the pivot point? Where must price prove itself? Is it a breakout level, a pullback level, a previous high, a previous low, a failed breakdown, a volume zone? You need a level that gives meaning to the trade. Without a meaningful level, your entry is random. Question 3. What will prove me wrong? This is the question that saves traders. Before you enter, know your exit. Not after, not when you are already emotional. Before, if you cannot define your risk, you have no trade. Question 4. Is volume confirming the move? A move without volume can still work, but volume tells you participation. When price moves strongly through a key level with high volume, it means more traders are involved. It means the move has energy. Question 5. What is my emotional condition? Am I calm? Am I patient? Am I clean? Am I angry, greedy, bored, desperate, or afraid? If your mind is not clear, even a good setup can become a bad trade. The same chart in the hands of a disciplined trader can make money. In the hands of an emotional trader, it can destroy money. The setup is only half the trade. The trader is the other half. Let me tell you a story. A stock had been falling for months, from 150 to 120, from 120 to 100, from 100 to 80. Everywhere people said it is cheap now. At 100 they bought. It fell to 90. At 90 they bought more. It fell to 80. At 80 they said it cannot go lower. It fell to 65. They were not buying strength. They were buying hope. Then one day the stock stopped falling. It moved sideways between 60 and 70 for several weeks. Most people had already lost interest. The news was bad. The crowd was tired. But a careful trader noticed something. Every time price touched 60, it bounced. Selling pressure was no longer pushing it lower. Volume started to dry up on declines. Then suddenly price moved above 70 with strong volume. That was the first sign. The line of least resistance was changing. The pivotal point was 70. The market had revealed strength. The trader entered, not because the stock was cheap, but because the market confirmed buyers were returning. That is the difference. Never buy because something is down. Buy because it stops going down and begins proving strength. Never short because something is up. Short because it stops going up and begins proving weakness. Confirmation is the bridge between idea and execution. Without confirmation, you are walking in darkness. Now I will tell you something that sounds simple but is very hard. Making money is not only in entering the trade, it is in holding the right trade. Many traders find a good setup, they enter well, then they take profit too early because they are afraid. They make small profits and large losses. That is a losing formula. The market gives big money only to those who can sit through normal movement. A strong stock will not go straight up. It will shake, pull back, scare you, test your confidence. Why? Because the market must remove weak hands before continuing. If you sell every small pullback, you will never catch a major move. But do not misunderstand me. Sitting tight does not mean holding a losing trade forever. That is foolishness. Sitting tight means holding a winning position while the original reason remains valid. If the line of least resistance is still up, sit. If the pivotal point is still holding, sit. If volume and price behavior remain healthy, sit. But if the market breaks your level and proves you wrong, exit. No debate, no prayer, no drama. Take the loss and live to fight another day. The professional is not loyal to a stock. He is loyal to truth. When the truth changes, he changes. This is why flexibility is strength. A stubborn trader wants to be right. A great trader wants to be aligned. You may think trading is about charts. It is not. Trading is about character. The chart only reveals what is already inside you. If you are impatient, the market will expose it. If you are greedy, the market will punish it. If you are fearful, the market will use it against you. If you are disciplined, the market will reward you with time. Not every day, not every week, but over many trades, discipline becomes visible. The goal is not to become a perfect trader. There is no perfect trader. The goal is to become a controlled trader, a trader who waits, who observes, who accepts losses, who protects capital, who understands that the market is bigger than his opinion. Remember the 3 indicators. The first, the line of least resistance. Do not fight the main force. Find the direction where price wants to move. The second, the pivotal point. Do not enter randomly. Wait for the level where the market reveals strength or weakness. The third, the operator's mirror. Do not only study the market. Study yourself, because your greatest profits will come after you master your behavior. Most traders will never find these indicators because they are looking for something outside themselves. But the real edge is not just on the chart. It is in your ability to wait when others rush, to act when others freeze, to cut loss when others hope, to hold winners when others panic, to remain calm while the crowd loses its mind. That is the way of the true operator. Not noise, not prediction, not excitement. Recognition, patience, discipline. The market will always tempt you. It will whisper, "Enter now." It will shout, "You are missing out." It will laugh when you lose. It will seduce you after you win. But if you can stand apart from the crowd, if you can read price honestly, if you can wait for the pivotal point, if you can follow the line of least resistance, if you can look into the operator's mirror and control the man inside, then you will no longer trade like the 90%. You will begin to think like the few. And in the market, the few are the ones who survive. Pause. Because the goal is not to trade every day. The goal is to be ready for the day when the market finally offers you the trade worth taking. If this lesson gave you value, subscribe to the channel, because the market does not reward the loudest trader, it rewards the most disciplined one, and discipline is built one decision at a time.